Today, we are picking a stock in the consumer electronics space. This firm is known as India's reply to Foxconn and has established partnerships with major players like Xiaomi, Nokia, Samsung, and potentially with Apple. It's either the market leader or at least in the top 3 across all the segments that it is present in. However, last week Jefferies downgraded the firm to underperform due to softer demand in the market and is wary of its high valuations. Are we at the end of the bullish run of this firm? चलिए जानते हैं. तो शुरू करते हैं एक unbiased coverage just based on facts on one of the brand behind the brands, Dixon Technologies. My name is Ashish Thomas. I'm an IIM graduate and a management consultant. My daily job is to evaluate firms, understand their risk, and anticipate market moves. And I thought, why not apply all of this to the stock market? Also, a huge shout out to everyone for being with me and helping me complete 1 month of my YouTube journey. Would not have been possible without your kind words and support. With that, let's jump right in. As with our previous videos, we begin with an industry analysis and then move on to the business model. We'll then take a peek under the hood on its financials. फिर इस कंपनी के रिस्क देखेंगे and finally the valuations. With that preamble, let's dive in to understand the winds of change in the industry. Indian electronics manufacturing space is expected to triple to $242 billion by 2027 and will contribute to 7% of the global market share. The Indian domestic production is expected to grow at 24% CAGR and domestic demand at 15% CAGR. This also gives a lot more room for India to promote its exports. Nearly 50% of the market is expected to be mobile driven, followed by circuit boards and then the industrials. There are a few things that are working out for the market at the moment. डोमेस्टिक साइड पर एक ग्रोथ है फॉर इलेक्ट्रॉनिक कंजम्पशन लाइक इलेक्ट्रॉनिक डिवाइसेस लाइक मोबाइल फोन्स वेयरेबल्स. आज की तारीख में इंडिया इज ओनली डूइंग 7% वैल्यू एड along with government policies. It's expected to touch 30% by 2028. For context, China is at 45% of the total value addition that it does today. Third, with all the trade wars which is happening, there is a China plus one supply chain strategy where all the big companies are trying to diversify their supply chain by including at least one more country apart from China like Vietnam or India in the mix. India में labor cost and electricity is at least 20 to 25% cheaper than China at the moment, which reduces the input cost for the company. And finally, there's a strong backward integration which is happening with the growing semiconductor production and support which we are getting from the government. So all in all, there's a good push for the EMS space. Now, as the global players try to navigate around the political landscape and supply chain bottlenecks, Indian government actually started creating an environment to make manufacturing attractive since 2020. Now, the PLI schemes which have come through are providing 4 to 6% incentive to all incremental sales which are happening. The other big change was the financial incentive of 25% Capex. So with all of that, with the remission of duties of taxes and the concession rate, India is now slowly coming on par with the production if you look at the handicap level. This means EMS industry of India is competitive now at the global level. Let's take a look at the largest players in the EMS space. Now, both in terms of revenue and market cap, Dixon Technology is the largest manufacturing, having presence in the largest mobile phone segment and the fastest growing circuit board segment. Kaien's Tech is present in the widest area of the EMS subsector except in the mobile phone. Bharat FIH, which is owned by Foxconn, is a huge competitor to Dixon at this time. We start with a quick glance from here on the highlights of the firm, then move on to understanding what is the competitive edge and the strategy of the company. Then we'll take a look at the news that the firm has been making in the market. With that, Dixon has around 30 years of experience in manufacturing consumer electronics product space. It is the largest Indian firm EMS by both revenue and market capitalization. उसकी 9 different product lines हैं, ranging from LED TV to telecom to mobile to security surveillance. It has 17 manufacturing units with 3 R&D centers. They have also another 6 planned to start by FY 24-25. Now, there are 3 things that give Dixon a competitive edge based on its current strategy. Fully integrated है तो पूरा end-to-end product solution suite वो बनाते हैं. So the OEM can focus only on the R&D and develop new products. Now, this becomes difficult to provide this end-to-end suite for new players who are entering the market. दूसरा, Dixon is creating a diversified product portfolio to expand its revenue stream. It's already a market leader in TV, washing machine, CFL, LED. Now with entering the new markets like drones, EV, it's creating more ways to earn the income. And finally, with the long-standing customer relationship and the joint development manufacturing model that it has entered into, Dixon is expanding both its market share and is able to develop new products. It's already received exclusive deal to produce Google and Android TVs and has exclusive partnership with all the CCTV brands. This is giving Dixon a high revenue visibility and the presence in the market. Finally, there are a lot of news that impact Dixon. One thing to remember is Dixon reacts very sharply with every news. So what I've done is I've put in few news and transported against the share price which is increasing. Signing of any new customer from Lenovo to Compal to Xiaomi is going to increase the share price because it gives the clear revenue visibility. New factory establishment is a big capacity move. Again, there's a huge uptick reaction which happens. Any kind of down rating which happens puts the share down. So a good thing to remember is this is more like a trading stock which it is becoming from a share price perspective. However, if you remember, India is planning to add 30% value to domestic manufacturing from 8% today. So as that happens, there is going to be higher revenue and margins for Dixon in the future. With that, let's move on to our next section, the financials. Numbers don't lie. Before we go there, आपने काफी सारे stock videos देखे होंगे, but very few are going into the kind of depth like we are going today. So please go like the video अगर you haven't already and do subscribe. वहाँ पे एक bell icon है, all notifications click कीजिएगा so that you're up to date because I'm launching a new company analysis every 3 days. We have 2000 stocks, 365 days, तो content तो काफी आने वाला है. Some typing and a quick search later. We're going to use December 2023 numbers, the updated numbers for this analysis. Dixon's revenue grew by 33% from last year because of the increased sales. EBITDA margin and net income margin both improved due to the higher sales in the last 12 months. Having said that, the EBITDA margin is really low at 10%, and in fact, if you look at it, core business, it's as low as 4%, which is actually very concerning because it gives a very less wriggle room if the input cost increases. इस साल वो इंडिया का फर्स्ट ODM बेस्ड गूगल टीवी डिस्ट्रीब्यूट किए हैं एंड सैमसंग फॉर द टाइजन ऑपरेटिंग सिस्टम का डील हुआ है. They also started injection molding shop for TV and have also invested heavily into the LED bar assembly line. So इससे backward integration हुआ है and margins में improvement हुआ है. On the operating front, operating cash flow काफी increase हुआ है because of the reduction in inventory level as new business ramp-ups have happened in Jio, Airtel and Telecom. So a lot of the inventory is being deployed right now. Capex has increased by 10% to overall 4.5 billion. And if you look at year-on-year revenue growth, it's almost 100%. So firm is in a fast growth phase at this point. The ratios, of course, because all the numbers are good, ratios are very healthy when you compare it against the industry. Its low debt to equity ratio ensures that it is it's ready to get more funding if it wants to do expenditure. Its return on capital employed is higher than the industry mean, ensuring efficient processes. Interest coverage ratio is 8, ensuring it can repay interest incurred and some more for the year. So management has already indicated that they will be repaying aggressively starting this year. Equity research analysts have predicted that the share price is only going to increase by 1 to 2%. However, if you look at the revenue numbers, 27% growth होने का expectation है. Return on equity is going to grow to 29%, which makes it a great investment. But the 260% jump in 1 year really has made them queasy about the future bullish growth. Analysts believe that the company would grow with its expanding product basket, product penetration, and a very strong order book. We also need to remember that as you look at quarter to quarter, these analysts have kept re-rating the stock continuously as it continues on its unstoppable upward trajectory. Final note on the shareholders, the holding pattern is really stable. There has been some insider selling of around 0.2%. This is not really concerning at the moment because promoters are known to sell small pieces of share and buy back to make some money. When compared to the 26% stake, it's a really small portion that was sold. On the same breath, FIIs have actually increased by 2% with 326 investors like Abu Dhabi Sovereign Fund, world's largest PE firms like Vanguard, Blackstone, even India's HDFC Asset Management being present in the mix. So a really strong set of institutions which are present in the mix. With every great investment comes some noteworthy risk. There are 4 areas of risk which go along with this high growth company. Any delays in the capacity expansion or increase in the Capex cost can impact both the partnership and, if you remember, the margins too. There is a potential volatility in the raw material prices that can impact Dixon's business in the ODM space at least. Demand for manufacturing is dependent on end consumer demand also. So any kind of softness can result in the reduction of the order book, which is exactly why it got downrated recently. Finally, increased competition in this space with international companies like Foxconn and Pegatron opening local shops in India through government support and joint ventures can impact Dixon significantly. Finally, the most awaited section, or at least one thing that I keep important from my perspective, the valuation. Now, this is my football field valuation model. अगर आप equity research targets देखें, तो their low is 6582 and going as high as 7700. When I ran the relative valuation in my model and looked for trading comparables, I used Skynes Tech, Avalon Tech, Elin Electronics, PG Electroplast, among others. So the relative valuation is coming as high as 6300 to 8100. So they are slightly undervalued by industry perspective. However, you must remember that there are a lot of new companies in the growth stage in this mix, so they're still finding that efficiency in all their operations right now. I'll also add that the stock is trading at a PE of 120, which is significantly above the market median of 70. Its book value is only 242 rupees, which is way lesser than its current price of 7,000 bucks. And if you look at the intrinsic valuation or DCF, which is agar aap sirf financials ko dekho, it is coming out between 5,011 to 7,200 with a discounted cost of capital or WACC at 10.3% and a long-term growth of 6.5%. So the stock is just right price with not a high upside. From a valuation perspective, if you think about it, it's not a value buy counter at the moment. To fundamentally justify the valuation at the price level it is there today, it needs to be supported by high earning growths in every single quarter from henceforth. So final thoughts. अगर आप लोगों को कुछ भी अच्छा लग रहा हो वीडियो में तो जरूर लिखना what you like. Tell me what's the next share that you want me to look into and do not forget to click the bell icon to get all the notifications. The goods. Top 3 players, exclusive partnership, strong financials and strong order book really is working in Dixon's favor. The bads, it's a low margin business, so any kind of cost hikes or capex can result in financial pressures. It's also right price at this moment, so becomes more like a trading stock, which you can gain on every high. I think with that, my opinion is that there's not a lot of goods to Dixon as it seems. While there's a lot of news that can continue to keep the share price up, all the EMS players are currently suffering from high valuations and almost medium to long-term growth strategy. So this does not merit any fresh investment in the company at the current levels. That's all from me today. I hope this has given you a great starting point as you think about Dixon Technologies as a share. Do like the video and please drop in a comment if you like something or anything that I should change. आपके comments काफी valuable रहेंगे as I continue to build this channel. Do subscribe to the channel if you haven't already and please share this with all the like-minded investors. Do note that I'm not SEBI registered and these are my independent views and analysis. Please do your own research too and let me know what you feel about Dixon. And thank you for this 1 month completion with me in this journey. Thank you.